Centum has released half-year numbers. As always, we're delighted to have the man in charge, Dr. James Mworia. Karibu sana.
Thank you very much, Julian. It's always a pleasure to engage with you.
Asante.
Yeah, karibu.
James, we've spoken about potential share buyback time and again.
Yeah.
And as it were, this is the moment where Centum has finally announced. And first thing, when I look at the group level balance sheet and I look at Centum's cash position, it gets me a bit concerned in terms of the capacity to execute this, because when I do my math based on the quantum you're going for, that should be maximum about 600 million shillings.
Yeah.
Yeah.
Thank you very much. So, we've been talking about the share buyback since 2019. And remember, we sat here and you asked me why you're not doing it. And
Yes.
I said, look, we have a number of priorities. And our initial priorities were deleveraging the balance sheet. The second priority was just enhancing the dividend. My own objective was to make sure that all the capital that I found in the business when I took over CEO, I have returned it to the owners. And this year we succeeded in doing that.
Yes.
And we've also now paid, by and large, contracted to pay our lenders everything we've borrowed. So we're now sitting on profit. But the third thing is that we need to make progress in signing contracts on some of our more liquid investments so that we could have a path to cash.
Yeah.
And this half year, though it's not reflected in the P&L, we've made considerable progress in that regard. We signed new contracts worth about over 3 billion shillings. And these will be paid over time. So there's a mismatch between when we recognize it. We get the cash before we recognize the profit. So we have a path. We are a lot more comfortable from a liquidity perspective than we were, say, 2 years ago. We've achieved some of the objectives, which is why we now felt ready to go proceed with the buyback.
Okay.
The second issue is that at the time the regulations were not out, so it was a bit hazy how best to achieve it. We also wanted to monitor and to study how those who've done it before, the impact it has, and what objectives are trying to achieve. So there's been extensive internal debate. Whose interests do you take care of? Mm-hmm. And the side that won was, let's take care of the interests of the long-term shareholders. If you can buy shares back at 9 shillings vis-a-vis a net asset value per share of 60 shillings, so you're buying at a sixth, it means that every other shareholder benefits. Yeah. Because your dividend per share and net asset per share goes up, because our dividend policy is on an aggregate amount that is then divided by the number of shares. Now we'll have fewer shares. Yeah. But then also for those who wish to sell, the market conditions are such that now the liquidity is very tight. If you look at trading volumes, total market traded volume yesterday was probably less than 20, 30 million. So you may have shares worth 10,000 shillings and you go to the market and you can't get a buyer. Mm-hmm. And so what we want to do is to give those of our shareholders in that category a reprieve by being able to come into the market and step in and pick up the shares, especially when there's no other buyer available. Yeah. So what this does is that it gives Centum the option, but not the obligation, to acquire up to 10% over a period of time. Now, if you look at the traded volumes of Centum in aggregate in a year, it's about 30 million shares. Yeah. This is up to 60 million shares. So even if we were to buy all the shares that trade, would still not hit the 600 million shillings. And you're not even going to buy all the shares, because the shares that have caused the biggest challenge from a price perspective are lots below 10,000 shillings. So we've analyzed our trading volumes between shares that have traded above 1 million shillings blocks, 100,000 to 1 million, and 10,000 to 100,000. Yeah. The ones that have had the biggest impact on price are the ones that are between 10,000 and 100,000. And over the last 20 months, only 150 million shillings worth of those shares have traded. Mm-hmm. And those have moved the price from 17 shillings to 8 shillings. So that's what we want to be able to give also our investors some stability from a downside risk perspective. So if you wish to come and invest in the share, you have the comfort that the price will not go too low. Yeah. On account of very small volumes. So it's one of the many things we've been working, because ultimately the company has to work for its owners. Yeah. And sort of to create stability on that end, especially given where the market conditions are now.
Okay. Yeah. Speaking about the market conditions, I look at the timing of the share buyback and I'm wondering, Is the timing a bit inauspicious? If you look at the market, the benchmark indices are down quite significantly. Trading is subdued. NSE itself has just issued a profit warning. Aren't you worried about the timing in the event that even if you try to rescue the share price?
No, we're not rescuing the share price. We are not interfering with the share price, which is why we went with the regulation as it is, 10% above the volume. What we've seen from the previous share buyback that was there, NMG, even when they bought at a higher price, the price then drifted back. So it means value has been transferred from the remaining shareholders to the exiting shareholders, which is why we sort of agreed with the regulations when they said do 10% above the volume weighted price. So we're not rescuing the share price. All you're doing is giving liquidity to that shareholder who presents their shares into the market. And also we are not enticing any shareholder to go. We don't think anyone should be selling at this price.
Yeah.
But if you so wish to go and sell, we don't want you to lack a buyer. Especially, we can now focus on smaller volumes because we'll be buying like any other buyer in the market through the broker. So I think especially now it is important because you can have many shareholders who get stuck where they have monetary needs and they cannot get a buyer for their shares and it's not a lot of money. And we don't want our shareholders to take a disordinate hit because of liquidity. So in a sense, it's also assisting those shareholders who wish to sell, liquidate their investment in these difficult times, give them a way out.
Okay.
Yeah.
Earlier this year, we saw Diageo take the off-market route. Is this something you weigh?
So Diageo is very different because Diageo is not a share buyback.
Yeah.
It is a shareholder of Breweries, which is a listed company, who wants to buy more shares.
True. So
that would have worked if one of Centum's shareholders wanted to buy more shares from the market. So that is very different. What Diageo did was a tender offer. But this is the company itself buying its shares back in line with the regulations as an on-market purchase over a period of time. Yeah. So it's a very different structure.
Absolutely. James, sometimes I look at the structuring of the Centum business in terms of identifying opportunities, deploying capital, realizing return. And I wonder, would Centum be a lot better placed if it was not a listed entity as opposed to being a listed entity in terms of price discovery?
You see, that's a question I've battled with. But I found the company listed. I leave it listed. So you work with what you have as it is.
You're a funny guy.
you work with it. So obviously being listed means you are under a lot more scrutiny, you are under a lot more pressure, you're reporting earnings semi-annually. The reporting is not necessarily aligned with the way the investment returns. You're communicated to a very broad audience. You have sophisticated investors, you have very unsophisticated investors. It just makes the job a lot more challenging. But it's very basic, it's a simple investment job. How much capital did you start with for your owners?
Yeah.
How much have you returned? How much value have you created? And what is your game plan to convert this value to more value and cash that you can continue returning to your investors? Put the share price issues aside for a minute. And that's how I see it. And then how can you take advantage of every situation? The share price is low. How can I do my mandate better of rewarding my long-term investors? And how we can do our mandate better is by buying back these shares cheaply so to increase aggregate net asset value per share for a long-term investor. So during COVID, I started playing golf. And one of the things the trainer told me, you play the ball as it lies. So I'm okay with the way the field is. I play with it as it lies.
Great. I'm really intrigued by a share buyback exercise protracted over 18 months. The precedent we saw in this market took about 3 months.
Yeah.
Maybe just care to elaborate why.
You see, okay, we've not had many share buybacks to begin with. So what the regulations provide is that you can have two kinds of buybacks. One is an on-market buyback. On-market buyback means you buy the shares from the stock exchange like any other buyer. But then the two things that must be prescribed. What is the price range? Now the price range is set under clause 7 of the buyback regulations. It's 10% above the volume weighted price. And what volume of daily traded shares can you buy? it's 25% or any other percentages may be prescribed by the CMA. So that's what we'll be seeking exemption for, because given the very low trading volumes, 25% may be very low.
True.
Now, the regulations also allow you time to buy back the shares. Now, if you think about, even before we had these low trading volumes, Centum used to trade 5% of its shares used to trade per year. So you're talking over 2 years, 10% would trade.
Yeah.
So actually over 18 months, even if we're the only buyer of shares, we don't have 10% of Centum shares coming into the market to be bought. So the 18 months is in the context of an on-market purchase and the traded volume. What you saw with NMG is an off-market purchase.
Yeah.
An off-market purchase now presents a different set of challenges. One, if you make an offer at the current low value and subsequently the price does converge, these people who sold may come to you and say, you enticed us with misleading information to sell our shares to you cheaply for the benefit of a few shareholders.
Yeah.
If, on the other hand, you buy it expensively and the price comes down, you've then transferred value from existing shareholders to the selling shareholders. So it presents a different set of challenges. It was not our intention to go out there and get shareholders to sell at this price.
Yeah.
It's not our intention. But however, we felt obliged to give our shareholders a stopgap level, especially the smaller shareholders who want to sell their shares and they can't find an off-taker for these shares on account of no fault of their own. And this is a program. It's an 18-month program, meaning for 18 months after the shareholder shareholders pass the resolution, at least you are assured that if I go with my 1,000 shares, at least there's a buyer.
Yeah.
There's a buyer. Then also you wish to buy. I was talking to one of our larger shareholders who said, look, James, I bought more than 5 million of your shares at 15 shillings, but some fellow came with 5,000 shares and sold them at 9 shillings. So he's depressed my price. So even for that person, you can tell them, don't worry, buy a 10 bob, buy a 12 bob. But if it comes to 9 bob or 8 bob, we'll pick it up. But on the other high end, we are not competing with you. You're free to buy the shares. So it's not our desire that shareholders sell their shares, especially. But should you wish to sell, we don't want you to get stuck in the market or to sell them very cheaply because of liquidity constraints, especially now.
James, one of the technicalities precipitated by a share buyback is that because you reduce your float in the market, and especially in a market such as Kenya, where a lot of the activity is driven by foreign players who come in through bulk purchases and exits. In the event that someone wants to come in and through a lump sum purchase and you've squeezed your float, does that concern you?
You know, we love the treasury shares. So if you wish to come and buy shares from us, now we have something to offer. We might sell them at 30 shillings. We might sell them at 40 shillings. We can negotiate. Yeah. But we can negotiate without diluting the shareholders. Because the constraint we've had over time, and I spoke to you at the last interview, is that the existing set of large shareholders did not want dilution. Yeah. Now that is what in CFA you call an investment policy statement. Those are the objectives of the investor. You don't argue with the objectives. Now you have a treasury stock which you bought cheaply at a deep discount. Yeah. If in the future you wish to sell, somebody comes and says, I want to invest $10 million, $20 million, say, okay, you can buy my treasury stock. And no one is worse off. In fact, the existing shareholders will have made a profit. Yeah. Yeah.
The question has been asked whether it would have been more worthwhile to just redeploy this amount into a dividend.
You know, the challenge with the market is, and that's why sometimes I listen to the market and I also don't listen to it, is that you cannot please people. You know, initially they said, we want a dividend, then we want you to invest, then we want you to pay debt, then we want you to do a buyback, then we want a special dividend. So you have to take it in sequence. So we have a clear dividend policy. Yeah. And that is at 30% of annuity income. We've taken time. We were very clear that we had other strategic priorities before we get to the share buyback. We are more or less made progress on those strategic priorities. So we're not going, for example, to bring a buyback ahead of a deleveraging. for us, deleveraging was more important
Than the buyback.
Because we could see in a high inflation environment, or where we're headed, there were going to be high interest rates. So the cost of debt was only going to get higher. So you see if interest rates go up, asset prices come down. So if what you have is an asset that you want to liquidate to pay the debt, it's easier to do so earlier than wait for later when liquidity is tighter. So for us, that was a more urgent endeavor. Having accomplished it, it is important then to follow through with your commitments and say now we are at the share buyback stage. So in our balancing, we'll balance new investments, share buyback. But what gives me comfort in all this thing is that everyone's capital is back.
Yeah.
So as a fund manager, I sleep well at night knowing everyone who has lent us money, we've paid them.
Yeah.
All the capital we found in the business, we've returned. We are now juggling the profit. So I'm happy to have debates around how best do we deploy this profit. Has it gone up 4 billion? Has it come down 2 billion? It is our profit that is fluctuating in value. So to that extent, I sleep very well at night. I'm very satisfied.
On that note of the leveraging, James, you have indicated that in the second half you want to retire all dollar-denominated debt.
Yeah.
First is, what's the quantum? Second is, how tough has it been? We all understand the FX challenges this market and many others are facing. How has it been just to service your dollar-denominated debt?
Okay, so let me start the question. So right now we have about $15 million left in Centum of our debt. Why did we take dollar-denominated debt originally? It was a lot cheaper. When there was quantitative easing, there were a lot of dollars. Rates were very low, so we were borrowing at 5%. Whereas Kenya shilling debt was 13%, so you had a differential of about 8%. And you could borrow internationally cheaply. So it made sense to borrow in dollars. But in 2018, 2019, our view was that this was not going to last, which is why we made a decision to make exits and first start by retiring the dollar-denominated debt. And had we listened to the market, we would not have done it. But we nevertheless went ahead and did it, and the share price took a hit. But had we not done it at the time now, the currency depreciation alone of the $100 or so million we had in debt would have been a large amount of money. So we are down to $15 million. So what we want to do, because we have a value uplift on the exit of our assets, under the value uplift, we've not yet booked it through the balance sheet. We're still carrying it at the original valuation, the markdown valuation. The idea is just to use the uplift and to retire the dollar-denominated debt. So there's no impact on total assets, and you've reduced the liability. The other dollar debt, there's a small portion still with Centum Re, which they are now converting into a Kenya shilling debt. The good thing with Centum Re, their receivables far exceed their liabilities. So that's normal working capital financing. How difficult has it been? At least for us, we have some dollar inflows. So we've also tried to match our assets and shift to more to dollar assets.
To the MSP.
To the MSP.
Yeah.
So we'll end up now being more dollar assets, because before dollar assets did not make sense because the yields were very low.
Yeah.
But now it has inverted. The yields on dollar assets are high, and there's a risk if you're in anything else other than dollar. Should rates go up in dollars, you may suffer for FX losses. So it has been moderate, but the impact has been on these FX losses on revaluation, and also for some of the subsidiaries, as the rates have gone up internationally, because these are floating rates, the interest rates have been creeping up. So you're taking a double hit. You're taking a hit on cost of borrowing, and you're also taking a hit on the aggregate amount now you have you're sitting on.
Yeah.
So the amount of shillings you need to service are now more. So it was yet another shock.
Okay.
Yeah.
And speaking about the MSP, I'd like to understand the exposure on the Eurobond side. I had a mention of Egypt.
It's Egypt and Kenya.
Egypt and Kenya.
Egypt and Kenya. So our team at NABO looked at it. They have many Eurobonds issued. They are more comfortable. Actually, they have more in Egypt than Kenya. So it's Egypt and Kenya. We bought at 72 cents to the dollar. Around July, there was a panic.
Yeah.
I don't know why. Markets behave like that.
Yeah.
So yields shot up to like 19%. So we came in, the aggregate thing was bought at 72 cents to the 72, relative to par.
Yeah. Yeah.
So as it matures, you have now two things which we didn't have before. Before we were just focusing on interest income. You have a capital gain perspective. Would have taken more, but just the pace of moving from domestic currency to getting the dollars to invest was also took a bit of time.
Okay.
Yeah.
There was a mention in your earnings about restructuring of a shareholder loan.
Oh, so what we've done, is that when we invest in greenfields, you must structure your investment in a way that it's easy for the money to flow back. So you have the basic investment goes by way of a shareholder loan, and then you charge some interest. And then when the company gets money, they then pay it back to you in the form of a repayment of interest and shareholder loan. However, in some instances, the way the law is now, I think as countries have become more aggressive on tax collection, they charge you tax on accrual, not on receipt. So if the company is not at a point where they are paying you, then there's no need of accruing, because they're actually going to suffer an outflow. So you'd rather just wait and make it a variable interest. So when you're paying me my 400, then I'll charge that time, because it's a way of getting our money back. So that's what we did for one of our portfolio companies, where they've still a shareholder loan to go, and they are returning capital back.
Okay.
Yeah.
I see. TRDL.
Yeah.
How is it doing? The last we spoke, there was scouting for a strategic investor. How are we doing?
It's doing well. It's doing well. I'm optimistic about it. We focused on two things. One, obviously, you have to scout for an investor. Two, you must focus on clients. The market conditions in 2.5 years were such that we couldn't do much business development. When you speak to people, you know, everyone was on a wait-and-see attitude. We've seen a lot of positive reaction. You know, we're not building a mall, we're building a city.
Yeah.
So if you think about which is the best location where you have room for expansion, where there's significant development sites that are ready, serviced with infrastructure that you can get and start moving, that is centrally located, that is not congested. You know, Two Rivers ticks all those boxes. By June next year, we'll have 850 houses complete within Two Rivers. So despite the challenges we've had, you know, the slowdown we've had in these 2.5 years, we've been resilient. We've just carried on with it. And now we are seeing a lot of customer interest. Customer interest is what drives investor interest. Once you have clients, you then have the investors coming in. So, you know, Two Rivers is like, you know, all our investments at one phase of their life or another, they gave me a lot of sleepless nights, and they have contributed significantly to my premature graying. So whether it was Almasi, at one time I used to wonder, was it a good idea to consolidate?
Yeah.
CDN, at one time I used to wonder what will happen to it. Two Rivers, I'm seeing light at the end of the tunnel. And I think it has done well. You know, if you consider the scale, and we opened in 2017, there were 2 elections. So everything we did was 2018, 2019.
Yeah.
Then from 2020 to 2022, we were sort of on freeze mode. And now we're taking off again. I think it will be a source of considerable value uplift for Centum and its shareholders. So just stay put. Let's see what happens here.
Considering the leveraging of the dollar-denominated debt, then we have the share buyback. I'd imagine everything else that could potentially have been in the pipeline by way of acquisition has been put on hold?
No, we're doing more things, but we're doing things that are more cash generative. So we have been putting more money into our private credit business. We created a private credit business similar to what we had with Platinum. So putting money through their payroll lending. You know, we are looking at investments that are cash generative, because asset prices are inversely correlated with interest rates. So if you are investing for capital gain, the environment is very tough. From 2009 to like 2019, those 10 years, the global conditions were great for a capital growth driven investment strategy. Rates were low, global liquidity was high, economic conditions were very benign. Now you must look at investments that will generate for you cash. So what we are chasing is yield. So we are trying. So we've created our own private credit vehicles just to create, because when we are putting in money through other third parties, we're only collecting like 17%. But when you're doing direct, you can get as much as 25, 26%. So that we just continue juicing up that yield as we wait for the cycle again to turn. If you go too early, you'll just be McTimey with no uplift. And if anything, there might even be yield compression.